The Canadian Agri-Food Policy Institute is driving bold policy solutions for a resilient Canadian agri-food system and building a stronger future for Canadian agriculture. Visit capi-icpa.com to discover how.
There's so much stuff happening in the markets here. It is hard to keep up, but you know what? Don't worry. You and I are going to get filled in right now by our next guest. We're going to talk markets here with Brian Comeault. He is with ICL Agriculture Markets based out of Winnipeg, Manitoba. How are we doing today, Brian?
Doing great, John.
How would you describe all this mess? Because today is red everywhere. Not good. But I guess what's happening in the broader complex here?
I think there's a number of things happening. I think that there's just some, I guess to start it off, just some winter malaise. We're getting into the Christmas season. I think there's some rebalancing happening here. I don't think that's the major driver today, but I think if you look back over the last couple of days, it's just been, pretty weak overall. But each market kind of has its own, little nuances that is kind of creating that overall. Yeah.
Now, for the last couple of days, we are seeing some pullback. Is that on good volume or is it on thin trade?
It's a little bit thinner, but I wouldn't call it. It's going to be higher than we'll see during the Christmas break. So I don't think we're into that kind of volume yet.
Okay.
Again, there are some, headlines, newsworthy things to talk about that is driving a lot of these things. So it is creating a little bit of higher volume. And even in the canola market, for example, we see high volumes into the close that actually are quite negative. They've been pushing, canola specifically negative. So we are seeing some good volumes. I wouldn't call them record volumes by any stretch of the imagination, but it's not too terrible.
Let's talk about the veg oil complex. And of course, we've got a lot of listeners. Depending on where you're farming, you're very focused on canola and you're very focused on soybeans. But one of the commodities that has been getting a lot of focus here in the past number of weeks is the wild ride of soybean oil.
Yeah.
And so let's talk about that.
Sure. Soybean oil is getting hit by a couple of different factors here. Today, specifically, I think there's two things happening. Number one is the recent NOPA crush and stocks numbers were, they're positive for soybeans. There was a really big crush. I think it was the second highest on record.
It was big.
But that came correspondent to a really high soy oil stocks, right? So if you're crushing more, you got more product. It's, instead of selling all of that soybean oil, obviously there's a building of stocks, and that has been pressuring soybean oil quite significantly over the last little while. We also have, and I'm sure you've seen this at the gas pumps, crude oil is in a pretty big decline recently. Its biggest decline, well, I guess there was some larger declines last week into the end of last week, but today we're seeing another 2.5% or $1.42 a barrel on the front month in crude oil. With soybean oil being so tied to energy prices now because of the biofuel complex or the component of biofuel, it's getting pushed down today by not quite by the same margin, but it has been significantly lower. Let's look here. Soybean oil. Yeah, it's 2.25% lower today, or a little over a cent. So now we're trading well into the 48 cents a pound area in soybean oil.
Yeah, like soybean oil's down 6 of the last 7 sessions. Like this is there's some momentum to this in the trade lower. I think I read too on that NOPA report, like as you mentioned, record crush volume or very high crush volume, but also negative margins for crushers, or did I read that wrong?
That could be. I haven't. I think it's low, and negative cash crush margins. They could be into the negative on the cash crush. On the board crush, there's still a positive number on the board crush, which is what I follow the most. But that could translate into, obviously translate into significantly lower cash. That could be in the negatives. That could be true. Yeah.
Now, because of some of the U.S. challenges when it comes to China on soybean exports, it does make sense why there's more domestic crush happening in the U.S., right?
Yeah, absolutely. Like they're trying to make up for some of that loss in exports overall. And there was a high demand. I think there was a lot of speculation that the demand for soy oil was for biofuel was going to continue higher. Another reason that this market has been pushing lower in soybean oil is because the Trump administration has now, or EPA, I guess, has signaled that they may actually only look at revising their policy into 2026. So I think there was some, rumor they were buying the rumor, or the rumor was keeping it higher. Now that we've seen, a push out onto that decision, I think the market is selling off as well. So again, multi-pronged approach to this downward move in soybean oil.
Okay, let's now turn our focus to canola. What do we know there, man?
Well, I mean, a positive note today is that canola, has been outperforming the vegetable oil complex today. It's only down, at this point, like $3 or $4 on the front month, significantly less as a percentage from soybean oil. So yeah, is soybean oil providing some pressure? Yes, but there's something holding it up as well. Obviously, we saw some really big declines after, StatsCan reported its 21.8 million ton production. Obviously, the December is generally thought of as not the final. There's usually additions to production that are added as time goes on with StatsCan. So I think most analysts are building something like that in. So, needless to say, it's a very, very large crop of canola. I think that is putting some pressure on the market, although I think that was kind of mostly filtered through now after the early December StatsCan report. Then it continued to move lower on soybean oil. But, we've seen a little bit of, I don't know if support's the right word. We did break to a new low, even lower than the November lows today. But it's being held up a little bit higher, or the losses are stemmed a little bit than some of the soybean oil would suggest. So there could be a kind of a balance, or maybe a thought that canola is a little bit oversold in this environment at this point.
Yeah, I'm just looking right now at the 1-year chart on the March future, and that 600 level. Don't want to push through that. That looks like that looks to be a bit scary.
Yeah, it's it is scary. It's 600 I think would be a psychological level. We are kind of moving now towards the March being the front month contract. There's more volume in there now. There's more open interest in there now. So the January is kind of coming to a close. So the market will turn its attention to the March, but I think looking back to those November lows is important too, because that's that was the front month contract for most of the new crop season. So we are kind of bumping down to that, and because there's such high carry in the market right now, the convergence to cash is lower. Means that the market has a bias towards lower convergence into cash. So that's having an effect as well as the new front months roll on.
Brian, one of the things I heard in the last couple of weeks from farmers and from the grain trade is because of the lack of movement of canola out of Western Canada, cars got to be filled and farmers got to create cash flow. And right. So people have moved to trying to move like wheat, and it's created kind of a scenario on wheat where there's there's pressure on some of those prices as well.
Well, the thing with wheat actually is the Canadian wheat export number is extremely high. We've been performing very well. Right? Yeah, because you're right. Those cars need to be filled. Elevators don't make money by sitting on commodity, right? They need to turn those wheels. They need to get that stuff into a car. It costs them money to hold it, even though, there's a lot of speculation that grain companies want to buy grain because they think that the price is going to go up, but actually they want to move that grain, right? They want to push it through the system. So, last year was a very good year for wheat exports. This year we're beating that right now. So from a Canadian standpoint, wheat is relatively well supported. Basis levels were really high as we came into, even into just a few weeks ago. We kept seeing the basis level rise, which is a local indication that there is demand for wheat. That's fallen off now for a couple of reasons. The futures decline is one of them. The other is the Canadian dollar is just on fire right now as well. But the wheat story is more global in scope. The supply of wheat globally is quite high. We're seeing some harvest activity now in Australia, which has a record crop. We're seeing some harvest activity in Argentina, which had record yields. So there's just some pressure being put onto the markets because of that. China actually recently has an agreement with Argentina to sell more, so they are stepping into that market. So, the U.S. and Canada may be losing out to some of those sales for Argentina as those new relationships grow. So it's quite dynamic. Obviously the tariff policy has a lot to do with it as well, but just good crops in a lot of areas in the world that matter to the market is another one.
Yeah, I know there's a lot of concern on the soybean front, the size of that Brazilian South American crop that is coming. There was, you mentioned Argentina selling some wheat to China. Talk about just for everybody that's not following it super close, type of wheat, and is it an easy substitute for Canadian or wheat out of the PNW?
Yeah, I do think it is. There is, most of the wheat that's consumed in the world is about 12 to 12.5% protein. That's what Argentina generally produces. The hard red winter, or in Canada we would call that CPS. That's the largest amount of consumed wheat. The soft red winter is more localized demand, particularly in the U.S. So not a lot of it is exported. The soft white wheat is exported a lot, but it's a very small crop. So yeah, it is that, the same type of product that we'd be seeing out of Ukraine, Russia, Romania, and those Black Sea areas as well. So that's all kind of putting pressure onto the market. And you can see that in the Kansas futures right now are trading at a discount to Chicago futures, which, is a bit of a head scratcher. I mean, it's understandable given these fundamentals, but generally speaking, we would consider the Kansas HRW crop to be a higher quality than the SRW crop. So it is, it's definitely underperforming the rest of the wheat complex.
Does that create some sort of opportunity? Because that is kind of a rare situation, does it create an opportunity to take advantage of?
I think the opportunity that creates is low prices create demand, right? The supply demand curve kind of moves lower, and it can incentivize a little bit more purchasing. The high protein wheat that we produce here in Canada still has a very healthy spread between, the lower quality wheats, the Chicagos and the Kansas City. So some of the protein premium is being built into the futures. So, Minneapolis futures have been, pretty flat comparatively to the other two wheat complexes. I think it is being held up a little bit by, even local demand here in Canada, and things like that. So it is performing well. I mean, it is kind of breaking below some support today as well, but it was holding on for the longest period of time. There could be a component there about lower volumes after switching to the MIAX from the MGE as well. So, it isn't getting the same amount of interest, but, it's still being used to hedge wheat in Canada here. So, there still is some reference to it. So it's been holding values higher than what, our U.S. counterparts would be seeing in losses on wheat.
What is really interesting is the story on Western Canadian wheat, really moving, exports being decent, is the same thing we've seen with corn out of the U.S. Corn exports have been really one of the big stories, filling the gap for the lack of soybean activity. So it's very fascinating how markets do find a way. We're talking today to Brian Comeault with ICL Agriculture Markets based out of Winnipeg, Manitoba. Went through a number of the different commodities that a lot of our audience is thinking about, Brian. Let's do the so what. Now what do I do? We've obviously got some people we got some carry out there, like you said. Bins are they're plumb full if you have the storage, and farmers trying to steer through this because there's so much. There's a lack of soybeans and canola, probably a higher amount of inventory on farm than normal, because people are waiting for the other side of this. When the market starts to work against us, that becomes an even bigger concern. What do we do here right now?
I think there's a number of different ways to look at it. I think, if farmers were to look at their sales that they've made already, which are likely to have been done higher than current market values, if they have enough there to carry them through into the new year, I think it's worth waiting and just kind of weathering the storm. That doesn't mean that the market is going to turn wildly bullish by any stretch of the imagination, but we all know that markets don't go in one direction forever. So this could be, kind of a sell the rallies kind of market. So, when there are rallies to take advantage of, I think that there's opportunity in those rallies as well. Even though the markets feel volatile, the volatility in the market is lower from a percentage standpoint. That does give some opportunity on risk management strategies like puts and calls and over-the-counter contracts that achieve those same results. So for all intents and purposes, some of those things are on sale. So if you do need to make a sale, but you would kick yourself if the market started to move higher after you made a sale, then those kinds of contracts are also very beneficial. We use them a lot here at ICL to manage risk and just to take advantage of opportunities. There are some opportunities in wheat as well. Like in our first segment there, we were talking about how basis levels for wheat have been strong. Yep. There's the Canadian dollar obviously has a big impact on that. It has really risen really fast. I think it could be due for a correction, which would help basis levels. I think it's worth separating wheat basis from wheat futures. So if you do see a good basis level, you might want to lock that in and wait a little bit longer. We don't normally advocate for basis only contracts, but I think when the basis is moving higher because of the demand, we talked about some of that high export number. I think elevators are looking for wheat, and although that may not have an impact directly on futures, I think it will have an impact on basis. So if you separate those two components, it might pay some dividends for you.
Growing up in a feed yard, there was a lot of focus on currency hedging, where you're trying to protect yourself versus a rising Canadian dollar. Not terribly common, I think, from a grain hedging standpoint. I think in July we asked Canadian farmers about this through RealAgri studies, and I think only about 5% of Canadian farmers were currency hedging. And some people have told me, Sean, that is really way too high. It is not that high, which I thought was kind of interesting. Do you think that more people should be thinking about, because that Canadian dollar rises because of the weakness of the U.S. dollar, you would be hedged against that risk? Is that something more people should consider?
Absolutely. It does have a direct correlation to particularly commodities that are denominated in U.S. dollars. So wheat, soybeans would be the two biggest ones. Corn in Canada is generally traded as a cash basis, so it has a little bit less of an impact. It has an impact on canola futures because those are all sold in U.S. dollars off the coast, so that all gets worked back. There are some of our clients who are doing some currency hedging, but they're doing it for a variety of different reasons. Some of those are because of the grain hedge specifically, but also there are some that are looking to make some equipment purchases in the future, possibly from the U.S. or even fertilizer. It helps to hedge against some fertilizer movements because that's traded in U.S. dollars as well. So I think there's some validation, but it does take a lot of education. There are some risks in it, especially if you're just using long or short positions to hedge. But I think that more farmers should be using it as a general rule, as long as they understand it.
Yeah, that is the key, right? And it was interesting. Yesterday I was in Hamilton, Ontario, and we were doing a farmer panel at a soil and crop meeting, and one of the farmers that said, they're using a lot of these tools, but they have to stay disciplined with some clarity because they turn in, they're supposed to be hedging, but then they turn into the speculator. It's so easy to turn into a speculator now. But there are strategies out there where, hey, create the cash, sell the crop, and then maybe go long the board on paper. Is it that sounds speculative, but it actually is a strategy?
It can be. The risk right now with a strategy like that, obviously, is that these markets are trending lower. Yes. So if you're biasing on higher prices, then you are speculating against the odds, I guess, is how you could put it. Or, we often talk about trying to catch the falling knife, right? People who try to pick the bottom.
Not fun.
Yeah, it's dangerous. It can work out sometimes, but that would definitely be put into the speculative folder.
Especially in this kind of market, for sure. I just presented as an example of what people have done in the past, depending on the right market conditions, for sure. Hey, Brian, if somebody wants to get your newsletter or maybe talk to you about becoming a client, how do they do so?
They can go to CanadianAgMarkets.com And we have a subscription button there that you can take a look at what we have to offer and just take a look at who we are and what we do.
Great stuff. Hey, Brian, thanks so much for joining us here today. Appreciate it.
You bet. Thanks, Sean.
That is Brian Comeault with ICL Agriculture Markets based out of Winnipeg.
For the latest ag news, agronomic advice, and more, check out realagriculture.com and RealAg Radio.